Welcome to Real Estate 360, an informative and engaging hour discussing everything you need to know about the world of real estate. Your host, Tom K. Wilson, provides you with insight and guidance from his years of experience as a successful real estate entrepreneur on how to buy, sell, finance, and invest in real estate, and much more. Now, here's your host for Real Estate 360, Tom K. Wilson.
Welcome back. Great to have you with us again. Thanks for tuning in to our Radio 360 program, your number one source for all of your real estate needs and education. We're broadcasting from the number one business radio station in the San Francisco Bay Area, KDOW AM 1220, the Wall Street Business Network. I'm Tom Wilson, your host for the Wednesday edition of Real Estate 360 that comes to you daily Monday through Friday at 3 p.m., along with my co-host, Joe Kuchera and Laurie Graymont. Make sure you tune in on each one of those days to get many different guests, different topics, all having to do with real estate buying, selling, investing. We are so glad to have you join us. We're getting so much feedback from everyone about how much they're getting out of the programs, and we intend to bring you much more rich content that will help you in your real estate decisions. If you can't make the live show, then you can catch our podcast on RE360radio.com, and you can catch my programs, TomWilsonProperties.com, or on iTunes. Got a great program for you today with our in-studio guest, Richard Crouch, who's been with us before, and welcome back, Richard.
Thank you. It's good to be back.
We're going to talk about a little bit about market conditions and what's going on. We like to give you in these programs as much as we can fundamental information that will that you can utilize over a long period of time, and indeed we'll have that. But also once in a while, our listeners and readers say they like to hear what's going on with the current market and try to see if we can help people make heads or tails out of what the heck's going on in this crazy dynamics. So we're going to talk a little bit on this first segment today about real estate bubbles, and are we in another one? So that's certainly a very popular topic. Everybody's saying, my gosh, it's going up so crazy right now. We must be in another bubble. We've seen this before. Should we get, is it time to be scared? Do we hurry up and buy something that we've been thinking about, or is it a dumb time to buy? Should we sell now or wait for things to go up more? All of those kinds of things are in every cocktail party conversation, and we got some stats that we'll put out there for you, and maybe even throw in our opinion a little bit. So Richard, let's talk about the real estate bubble potential. Certainly, when you see things going up fast, you look at that short-term curve and say, all right. You look at the mean over a long period of time, and it certainly has not gone at that rate over, say, 50 years. So it's definitely going up at a faster than normal mean rate. But then the question is it a bubble? So what's your thought about what the definition of a bubble is?
Okay. Well, first of all, let me just say that a lot of information on this. It's going to help people better understand what are we, in fact, in a bubble or not, where, our red-hot home sales here in the region are causing anxiety among some analysts who wonder if another crash is on the way, right?
Sure.
Now, let me just say that wonderful information will be that I'm going to share with you today in its entirety on my website, Richard and Candice, that's KANDIS.com, at Alon Pinnell. Be on the website so you can refer to it. That way you can just listen to this show and not have to try to write a bunch of notes. And I'd like to also give credit to the San Jose Mercury News and the KCM blog, who have wonderful information that helps us bring that to you today. So when it comes to the question of the bubble, I mean, rising prices are bringing on jitters. I mean, they're basically scaring potential buyers. Are we going to be shut out?
Indeed. How ironic. Something everybody thought would never happen maybe in their lifetime again, and here we're living it, and no wonder people are getting nervous.
It's just amazing. You really do know how much the great weather out here is worth. I'll tell you, after that recession we just went through, and to see this recovery is amazing. Just a couple of quick numbers. The last bubble in July of 2007 in the Bay Area, peak was around $738,000 for home prices. And today, our current prices, however, by no means that high, $564,000 in perspective. At the bottom of the market, when March 09, a good 20% less than that. Okay, so that in reality, we're still quite a bit below where we were. So across the 9-county Bay Area, cash buyers accounted for nearly 28% of May sales, and that's far above historical average of 13%. So why do we worry about the number of people buying houses for cash? Well, the main reason is that there's no constraints placed on them by lenders. They have enough money to buy cash. They probably have a lot more money. So what do they care if they pay a little bit more right now? They know that they're going to get a greater return on their investment. And so, unfortunately, for many who don't have all cash, prices get bid up rather significantly. So, for example, from March to April this year, 17% increase in 1 month. I mean, that's incredible. Okay, in fact, it's so incredible, it's never been that high in all the years that DataQuick, who's the company that keeps track of real estate numbers.
And a good resource, by the way.
Yeah, since 1988 is when they started. They've had nothing come close to that. Okay, so I guess the question is, are there significant risks for anyone getting into the market now? Well, if you look at it from the standpoint of being cautious, actually DataQuick's Andrew LePage said, absolutely, take away any one of the three things: ultra-low rates, interest rates, ultra-low supply, and ultra-high investor levels, and the market's going to feel it, So what is a bubble? I mean, it's probably important to understand that. Well, a bubble is defined by a large run-up in prices for an asset beyond the actual value of that asset. And bubbles are usually followed by a collapse in prices back to and below their true values.
So an important point I think you have there is that it's not just based upon a high appreciation rate. Because if it's still below what the mean should be over a long period of time, you're not in an overvalued position yet. So I think a bubble is a overvalued position. Now, you can debate a long time as to what defines that and what the constraints are, but just going up fast doesn't mean that it's going up in a bubble yet.
Exactly. I mean, everybody's kind of heard about all the legendary sales in Silicon Valley where offers of $200,000 to $400,000 above asking are not uncommon. This is predominantly in communities of Cupertino, Palo Alto, Burlingame, Menlo Park. But those prices are back pretty nearly as what they were before the last bubble. So that's something, however, that fortunately is not the average. That is kind of at the tip of things in the highest ends of Silicon Valley. But even low-priced homes, like in Alameda County and Contra Costa, are drawing multiple bids, many from investors. So is it a bubble? Anybody who tells you that they know it's going to be going on 6 to 12 months from now is probably blowing smoke.
I like to quote often my friend and Dr. Doug Duncan who's the chief economist of Fannie Mae, who's at about as high a level as you could expect for someone to get input on what's going on, especially in this government-influenced world that we're in. And when I've asked Doug in the past how he's going to play out, how this whole scene's going to play out, he said, if anybody tells you they know, run like heck, because I'm not going to claim that I know. I'll give you my opinion, but it's like giving a patient 27 pills and asking for a prognosis. It's just too hard to predict. We've never been in this situation before.
Right, exactly. But the fact is that there is evidence debunking the bubble theory. And let me share with you what that means. Home prices in Silicon Valley right now are basically 3% above their fundamental value. And that's not a big difference. It's essentially what you might expect in a normal market. And that's determined by incomes, rents, and long-term trends compared with in the 2005 timeframe, 59% above the value of at the time of the onset of the bubble that caused the recession.
Yeah, that's a major difference.
Major difference, okay? And in the San Francisco metro area, including San Mateo, Marin counties, prices are just 2% above the fundamental value. And
that's certainly not what you'd consider a bubble.
No. And in the East Bay, home prices are even with fundamental values, compared with 73% above them in 2005.
Man, isn't that amazing?
Yeah. It gives you an idea why Contra Costa got hit so hard, because 73% above fundamental value. So as I mentioned, the $564,000 median sales price of an existing single-family Bay Area home in May was 23% below its 2007 peak of $738,500. So the market's coming back, but it's not coming back as robustly as people think, because you're seeing this, what is really just a little spike up in a curve that's going to tail off as investors withdraw from the market and as there becomes more inventory and things become more balanced. And so you have to not just look at that one little segment of the curve, you got to look at the overall curve.
And indeed, largely the crash corrected a bubble that, that was certainly beyond the mean of long term. But what happened was when it came down with such velocity that it overshot the mean a bit and went under. So now we're working our way back up toward that long-term mean.
Yes. And, the Contra Costa County assessor, Gus Kramer, he said, I don't think there's a bubble per se because the number of sales are not even close to what they are in a normal market. But buyers should be careful about purchasing a home in some neighborhoods where prices have soared based on a few sales over asking price.
Just can't emphasize enough how much markets vary by submarket to submarket.
Totally.
People say what's going on in the real estate market. Well, it's thousands and thousands of submarkets across the country. Different price categories do function, even in the same neighborhood, can be quite different.
That's exactly right.
You have to understand, have to get somebody on your team who really understands that specific market that you're interested in.
Absolutely. And that's like local realtors or area realtors are so important. But just to add emphasis to what you just said, the Peninsula and South Bay have regained most of their post-bubble losses, while Contra Costa and Alameda counties still have a long way to go. So interest rate increases will eventually put downward pressure in Bay Area prices, said Dean Baker, the co-director of the Center for Economic and Policy Research in Washington, but none of us knows what will happen to us in the future. The current buyer frenzy has a number of ingredients, and we can talk about that in our next segment.
Yeah, so let's indeed continue there when we get back from this announcement. And this is Tom Wilson with Real Estate 360, KDOW 1220 AM, the Wall Street Business Network. Nice to have you with us today with Richard Crouch, our special guest back. We'll be back in just a moment.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back to the Real Estate 360 program. This is Tom Wilson with your Wednesday edition. We have with us today Richard Crouch, who's a entrepreneur, veteran Silicon Valley high-tech entrepreneur, and top producing real estate agent for Lon Pennell Realtors. Richard's used his high-tech background to help us track the market and follow it. So he's a regular guest on our program because he does such a good job with it. And even though we try to give you as much fundamental information as we can, we know everybody likes to hear what's going on in the marketplace and to help them with their timing decisions. So we're glad to have Richard back. And we've been talking about the real estate potential of a bubble, whether or not we're in a bubble or not. And in the last segment, we talked about, well, just the fact that things, the rates are going up fast, of our appreciation rates, that is, does not necessarily mean that we're in a bubble, because a bubble means that you've got prices which have gone higher than what the mean is. And so I think that's important for people to realize.
And higher, I might add, than the fundamental value of those assets. And carrying on from our last segment, the current buyer frenzy really has several ingredients. Interest rates kept low by the Federal Reserve, a low inventory of homes for sale, high rents relative to home prices, rising incomes and job security, and investors and others paying cash for low-end houses and condominiums. But despite the fear of the bubble, we just talked about the fact that homes are priced within just 2 or 3% of their fundamental value, and therefore there's a lot of consensus that we're not in a bubble. I'm just going to quote a couple of people here. Investors are not giving up yet. This is definitely not a bubble, said Geraldine Berry, who publishes a magazine for real estate investors. I think the market is looking good and will continue to appreciate for the next couple of years. And then Ken Rosen, who's an economist with the Rosen Consulting Group in Berkeley, expects the price increases to slow when interest rates rise and when more homes come on the market in response to higher prices. Now, if the prices do sag again, and that certainly they will at some point, it's really going to be the flippers, the fun term describing investors who buy houses to fix up and resell.
And we should say short-term investors, as opposed to long-term investors. Yes,
short-term investors. They're the ones that are going to feel the pain, according to Stan Humphreys, the chief economist at online real estate services Zillow. But in conclusion, speculators and short-term home buyers could be hurt by that emerging bubble. Anybody buying for 10 years, however, in the future, is not going to be affected. And, if you think about it, when you're buying a home, you're not really buying an asset, an investment, first and foremost. You're buying a place to live, first and foremost.
It's hard for us to keep that in mind when we live in a place like on the coastal cities that go into roller coaster prices, isn't it? But it's certainly it's true. And Robert Kiyosaki is the first one to say do not think of your home as an asset.
Well, that's right. And but I think it's comforting to know that you can take your mind off the value of your home and think about the great weather, the wonderful things to do, and the sophistication of where we live. Okay.
Indeed.
So. What I was going to do next, depending upon the timing of our segment.
Before you get into that, I just wanted to say that, I think there are three kinds of investors. One's long-term hold, and they don't care so much what it's doing in the near term as long as it's cash flowing.
Yeah, so especially cash buyers.
Mm-hmm. Mm-hmm. Yes, but even if you're not leveraged too high, then certainly a long-term hold buyers or as investors are ones that don't have to be as concerned as long as it's cash flowing. And as Robert Kiyosaki and many others remind us, always buy assets that produce cash as your number one priority. And then number two, you've got these short-term investors who certainly buy properties, add value to them, and sell them. And then you've got the third kind, which came in great force there toward the end of the bubble, and they really were the ones that were speculative investors, if you will, and they were hoping to make a quick buck, and some of them did. But when things started to crash, they are the ones who contributed to some of that early drop in prices. So let's wrap up some of those thoughts when we get back after this next break. But we have Richard Crouch with us today, veteran Silicon Valley entrepreneur and long-term real estate agent with Alon Pinnell Realty. And we're glad to have him here with us today. We're talking about the real estate market and real estate bubbles. And we will continue here in a moment on KDOW 1220 AM.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back to Real Estate 360 program, where today we have special guest in the studio, Richard Crouch, a veteran entrepreneur for Silicon Valley and a very experienced real estate agent with Alon Pinnell Realty, who uses his technical background to help track the market and helping us today to understand what's going on in this very dynamic market that we're in. Certainly it's dynamic at a national level, but you go down to the areas like the San Francisco Bay Area, and by golly, no wonder people are worrying about whether or not we're in a bubble. Should I hurry? Should I buy? Should I hurry up and sell? Do I wait? All those questions are being asked at every party and every meal, and we're trying to help you make heads or tails of that. So, Richard, you were just quoting a source, I think Zillow, and another one that said that probably the ones that need to be concerned the most are investors who are in it for short term, but they could get caught if they're counting on a short term profit. They could get caught if things have a little correction coming up. But there's certainly a number of indications here that we may not really be in a bubble yet.
Well, I think we've in the previous segment we certainly, using the term of that one of the terms that I quoted, debunked the fact that it's a bubble. Certainly not the same kind of a bubble from 2005, for sure. But just a small bubble that isn't going to perturbate, I think, the overall demand-supply curve. So I think what makes sense at this point is to share a few numbers. I'm going to do that first with Santa Clara County, which is alter ego Silicon Valley, because it is kind of the core driving force in the economy of the Bay Area. The good news is that virtually all of the Bay Area counties are doing well in response to what's happening in Santa Clara County. But just to put it in perspective, in May of 2013, a median home price up 3.8%, average sales price up 1.1%, number of homes sold up 11.3%, pending properties 2.2%. This is a positive thing. Foreclosures sold minus 4.8%. Short sales sold minus 18.7%, active listings 13.7%, and active foreclosures minus 23.1%, active short sales 27.8%, and average days on market has changed only plus 0.8%. Now, there's some revealing information on San Jose and Mountain View, taking two, that I think would be interesting to understand. Because none of us are looking just at a county, obviously. So when we come back in the next segment, I'll just comment on those. And keep so that's a couple of areas that give us examples of different submarkets. And indeed, like we said before, we've got so many different submarkets that are doing many different things, and you really need to keep track of that. So we got another minute or two here before we break. Yeah. Well, then let me just go ahead and comment that if we look at San Jose, the San Jose and the outlying areas that have been the last to benefit from the surge right now in Silicon Valley are starting to really benefit. For example, the median home price in May over a year ago up 38.8%. Now compare that to Mountain View. Mountain View and the areas closer into Palo Alto had already peaked, being the initial benefactors of the upswing in Silicon Valley, as the more higher paid workers living at that end of the valley were driving prices up. But in Mountain View, the change year over year in that same time in May of 2013 was only 9.2%. Okay, and average sales prices actually slumped a little bit. So the point here is that the demand is shifting to the east from the western end of Silicon Valley.
Okay, we need to take a break. We'll continue with what's going on in the local marketplace, and in just a moment. This is KDOW 1220 AM. Tom Wilson with Real Estate 360. We'll have you back in just a moment.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back to Real Estate 360, where we have special guest today, Richard Crouch, in our studio with us, who's a regular guest and entrepreneur from Silicon Valley who turned real estate agent with Lon Pennell Realty and uses his high-tech background to help us decipher the market. So, Richard, let's continue, and we can't go through this segment about what's going on in the marketplace and not talk about interest rates.
That's certainly true. I mean, and that's one of the things we pointed out, that market rates are expected to go up as they always do in an improving economy. Nothing new there. The good news is that even with increases, the historical prices of mortgages for homes is still at a very low level. And so you should not think that because they're going up a little bit, you don't buy.
Oh, gosh, I remember when I seriously expanded my real estate investments in 99, even though I've been investing since mid-'70s, the rates were 8.5%, and I was just delighted to have them.
Absolutely. So, the rate for a traditional 30-year fixed mortgage, as announced Thursday, this past Thursday, was 3.98%.
Oh my gosh, it's awful. It's so high.
Yeah, I mean, it's almost breaking the 4% level, And but to put it in perspective, 1 year ago, that same loan was 3.67%. Now, I know in talking to lenders, they do expect some additional increases, but nothing that would continue at that kind of a rate. Certainly remaining below 5 for the foreseeable future, and probably even low 4s in the worst case in the next year. Okay. All right. So we're
going to start talking a little bit about what buyers and sellers should be considering if they're on the fence about whether or not they should continue to look for something or whether or not they should go ahead and put their product on the market.
Absolutely. I think first of all, we should talk about sellers because they are the ones that have to kind of start the process. Can't buy without somebody selling, right? And so there's 5 really solid reasons why they should be selling right now. Number one, pretty obvious, demand is very high and supply is very low. Buyer traffic is up 31% from a year ago. And
that's very significant.
Yeah, and all these people are very serious about purchasing. I can tell you we've recently sold houses where on a weekend we have 150 buyer groups coming through. And this is a house priced in the 600,000s. And there are a lot of times 2 incomes in Silicon Valley companies, and they're just coming in one after the other. They want to move out of condominiums and townhomes where they don't have a yard, their kids have nowhere to play. Maybe even noise is a factor. They want to find that house, which is everybody's dream.
And let's face it, the market pretty much went to a screeching halt there in early 2008. And so now we have 5.5 years of pent-up demand.
Exactly.
And indeed, it's hard to find anybody, professional or personal, that I can think of, that I know of, who wasn't hurt by the downfall. Virtually everyone was.
Right.
Absolutely. I have an attorney neighbor whom I asked after a couple years. He was a bankruptcy attorney. I said, Sam, aren't you? You must be the only one that's benefiting from this. And he says, no, I'm having trouble. I said, well, why would that be? He says, all the corporate people who got laid off are competing with me. So it's real easy to be judgmental and thinking, well, maybe I'm one of the ones that got hurt, and a lot of people didn't. Everybody got hurt, but.
You know what, Tom? That's a really important thing because a lot of people, have a tendency to focus on themselves and their own what they think are their own shortcomings, and you know what? It's really not any individual in the Bay Area or anywhere else in this country, for that matter, that did anything.
We're all in this boat together.
We're all in it together. It's a normal, although severe, situation in the overall dynamics of the economies that we live in, and the future is going to have more ups and downs. But you know what? You got to hang in there.
And the key is to understand what's going on. What are the rules of the game? What's going on? And the more you're informed, the more you can make intelligent decisions about what to do.
Right. And so the sellers, for example, the second reason for selling now is that total housing inventory last month rose 12% to 2.16 million homes for sale. Now, that's in the country, of course. This represents a 5.2-month supply at the current sales pace, compared with 4.3 months in January. Now, frankly, here in the Bay Area and Silicon Valley, the supply is way less than that. There's houses that are still selling in 6 to 7, 10 days. But the fact of the matter is,
won't stay that way.
Yeah, that's right. So basically, selling now while demand is high and before supply increases may garner you your best price, especially if you have some uncertainty in the future that you need to eliminate. New construction, number 3. New construction is coming back. Builders are getting back in the game. You can see it all over the Bay Area, albeit, remember, there's very little land in the Bay Area that's available. So single-family homes, that's a tough one. You know, you just can't find them because there's nowhere to build them, okay? Number 4, interest rates are rising. Clearly, we understand that, and we just talked about that. And then finally, and we touched on this, it's time to move on with your life. Don't make decisions about whether you buy or sell based on the investment or what's happening in the economy or the value. Make the decision based on what's best for you and your family and your goals and your future happiness.
And whatever's happened in the past is water under the bridge or over the dam, and your business decisions need to be made on this day forward, not what's in the past.
Absolutely, and that's a rule of thumb that you can always live by because it'll put you in good stead.
Let's move over to what buyer side.
Okay, on the buyer side, let's see. Probably the fact that, in the last few months, buyers have been very active, and many of them haven't been able to buy a house, and there's a lot of concern there. But the inventory is going up, and if you have to have a really good realtor who can help you navigate and negotiate and compete and understand how to get a house when others are not.
Well, good. Well, let's take a break here for a moment, Richard, and when we come back, we will talk. We will look at the specifics of the reasons a buyer should consider buying at this point in time. This is Tom Wilson with KDOW at 1220 AM and the Real Estate 360 program on your Wednesday edition. So I appreciate you being with us. We got Richard Crouch today, veteran entrepreneur and real estate agent with Lon Pennell Realty, talking about the market that we're in, this very dynamic situation. We'll be back with you in just a moment.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back to Real Estate 360, where we have Richard Crouch with us today. Richard, let's wrap up this program with reasons buyers should still consider buying.
Okay, sounds good. I think what I want to point out for buyers is that many people are quick to criticize the real estate industry for saying, okay, buyers, you should go out and buy now. They claim it's self-serving, and there's actual data that proves that's not the case. So we go back to June 2012, just take a price of a home of $200,000 with a $40,000 down payment, $160,000 mortgage, an interest rate of 3.67%, resulted in a housing payment of $733.74 per month. Now, if you bring the clock forward to June of 2013, that same house is going to cost $220,000, up $20,000. The down payment is $4,000 more, so $44,000. The mortgage amount is higher, by $16,176. The interest rate is higher, 3.91 compared to 3.67, and the principal and interest $831.14, resulting in almost $100 a month more expensive to buy and a bigger down payment. So what that says, the advice of a year ago to buyers was correct. You need to buy, and that is still true now.
Okay, well that sounds like pretty good advice. Richard, if people want some more information or see some more of this data, how can they get hold of you, or can you give your website and contact information?
Yes, the website is Richard, and Candace, that's KANDIS.com, richardandcandace.com. And we are with the Lon Pennell Realtors in Saratoga, California. So you can go Google that or just call us, and we would be happy to answer any questions that you have. And this material will be on our website.
Fantastic. That's great. Thanks for being with us today. We, this question of whether or not one should buy or sell reminds me of the Lafitte Rothschild family, to which the great-grandson in the 70s was interviewed and asked to what single thing he attributed his family's great wealth, and they said by selling too soon. Mm-hmm. So don't be too greedy and try to hit the exact top and bottom of a market. If you see a situation which looks like it's good, you can capture an opportunity, go grasp it. Don't let that go on and wish you hadn't missed that opportunity. So that's Tom's top tip of the day. If you would like to go on our website, TomWilsonProperties.com, there's a report on how to find the best metro to invest in, and it takes into account the varying market cycles that go on in the various all the metros around the country. And also, you can sign up for our newsletter. Our newsletter will give you a weekly snapshot and about a 1-minute read on what's going on in economics in the country that drive real estate. So I think that'll be very useful to you. Again, you go to TomWilsonProperties.com, and you can get also our podcast there on the various topics that might be of interest to you. And you can go to iTunes and find the podcast, this particular one we're doing today and all the ones that we've done in the past. So we appreciate you being with us on Real Estate 360. Again, listen to us every day of the week, Monday through Friday at 3 p.m., or go on RE360radio.com to find the podcast, and again on iTunes for mine. So thanks for being with us today. We look forward to having you back next week for another edition on Real Estate 360.
You've been listening to Real Estate 360 on AM 1220 KDOW. For more information on today's program, visit RE360radio.com. That's RE360radio.com. AM 1220 KDOW.